In January 2019, WeWork was valued at $47 billion. 9 months later, its IPO was dead. Its founder was out as CEO, and the company needed an emergency rescue that valued it at just $8 billion. Then, 4 years later, WeWork filed for bankruptcy. But here's what makes this story strange. WeWork wasn't selling a fake product. Coworking didn't disappear. In fact, WeWork itself still exists today. So how did a company with hundreds of locations, hundreds of thousands of members, and some of the richest investors in the world manage to destroy so much value? To understand that, you have to understand what WeWork was actually doing. Because underneath the talk of community, technology, and changing the future of work was a very simple business, and a very dangerous mismatch. WeWork was founded in 2010 by Adam Neumann and Miguel McKelvey. The two had previously worked together on Green Desk, a shared office business in Brooklyn, before selling their interest and starting WeWork. The basic idea was easy to understand. WeWork would lease large amounts of office space from landlords, redesign the buildings into attractive shared workspaces, and then offer desks and offices to individuals and companies looking for flexibility. For a customer, the appeal was obvious. You didn't need to sign a traditional office lease, furnish an entire workplace, or commit to more space than you needed. You could move into a WeWork, get Wi-Fi, meeting rooms, communal areas, and a ready-made office. But WeWork wasn't only selling convenience, it was selling an experience. Its offices looked less like traditional corporate buildings and more like fashionable hotels or clubs. There were communal spaces, events, and an emphasis on meeting other people working in the same building. That helped turn an old idea, shared office space, into something that felt new. And WeWork grew incredibly quickly. By June 2019, the company had 528 locations in 111 cities across 29 countries. It reported 527,000 memberships. That scale helped convince investors that WeWork wasn't just another property company. It looked like a company that might transform the way millions of people worked. And one investor believed in that vision more than almost anyone else. SoftBank, the Japanese technology conglomerate led by Masayoshi Son, poured billions of dollars into WeWork. In January 2019, another SoftBank investment valued the company at $47 billion. That number was extraordinary. But it also created a problem, because WeWork now had to grow into a valuation that assumed an enormous future. And growth was expensive. Every new WeWork location could require another lease, another renovation, more staff, and more money. The company expanded rapidly. Revenue grew rapidly too. In 2018, WeWork generated around $1.8 billion in revenue, but it also recorded a net loss attributable to WeWork companies of around $1.6 billion. That doesn't automatically mean a growing company is doomed. Many young companies lose money while expanding. The more important question was whether WeWork's underlying economics would eventually become strong enough to justify the enormous amount of money being spent. And that brings us to the most important part of the story: the leases. Imagine you sign a contract promising to rent a building for 10 or 15 years. Now imagine that the people paying you to use that building are allowed to make much shorter commitments. If business is good and your building stays full, that can work. But if customers leave, their payments can disappear far faster than your obligation to the landlord. You are still responsible for the building. That was a fundamental risk inside WeWork's model. And as WeWork expanded, the size of those long-term commitments became enormous. In August 2019, the company finally opened its books to the wider investing public. WeWork was preparing for an initial public offering, an IPO, which would allow its shares to trade on the stock market. On August 14th, it filed its registration statement with the US Securities and Exchange Commission, and suddenly, potential investors could examine the business in detail. One number stood out. As of June 30th, 2019, WeWork had approximately $47.2 billion of future minimum lease payments. Those payments were spread across future years. They were not a $47 billion bill that had to be paid immediately. That's an important distinction. But they represented enormous contractual commitments. At the same time, WeWork reported only $4 billion in what it called committed revenue backlog. In other words, WeWork had locked itself into huge future payments to landlords, while the revenue committed by its customers covered a much smaller amount. And the financial concerns weren't the only thing investors discovered. The filing also revealed unusual transactions involving Adam Neumann. WeWork disclosed that it had leased properties from landlord entities in which Neumann had ownership interests. That meant the company's own chief executive had financial interests connected to properties being rented by the company. WeWork itself identified these as related party transactions. Then there was the name. Earlier in 2019, WeWork's parent company had become the We Company. The company disclosed that an entity associated with Neumann and other founders had received partnership interests worth approximately $5.9 million in connection with rights to the We trademarks. After the arrangement attracted criticism, the transaction was reversed and those interests were returned. Then there was Neumann's control over the company. WeWork's IPO documents disclosed a share structure that gave him enhanced voting power and substantial influence over decisions. None of these facts by itself explains WeWork's collapse. But together they created a much bigger problem. Public market investors were not evaluating the company the same way its private investors had. They were looking at the losses, they were looking at the lease commitments, they were looking at corporate governance, and they were looking at a $47 billion valuation and asking whether the business underneath it could actually justify that number. The answer from the market was brutal. WeWork began considering an IPO valuation far below $47 billion. Reuters reported that the company was considering a valuation as low as around $10 billion. Then the IPO was postponed. On September 24, 2019, Adam Neumann stepped down as CEO and gave up majority voting control. And on September 30th, WeWork formally withdrew its IPO. Think about how quickly that happened. At the beginning of 2019, WeWork had been valued at $47 billion. By the end of September, it couldn't complete the public offering that was supposed to be its next great milestone. And there was another problem. The IPO wasn't just about prestige. WeWork needed access to capital. The company's rapid expansion and heavy spending meant that losing the IPO created an urgent financial problem. So SoftBank stepped in again. In October 2019, SoftBank agreed to a rescue package worth about $9.5 billion. It included $5 billion in new financing, the acceleration of an existing $1.5 billion funding commitment, and a tender offer of up to $3 billion for existing shareholders. The deal valued WeWork at roughly $8 billion, from $47 billion to $8 billion in less than a year. That was the first WeWork collapse. But it wasn't the end of the company. Under new leadership, WeWork began cutting costs and trying to repair the business. Then, just months later, another crisis arrived. COVID-19. It's tempting to blame the entire WeWork disaster on the pandemic, but that would be wrong. The famous IPO failure, Neumann's departure, and the collapse in WeWork's valuation all happened in 2019, before COVID shut offices around the world. The pandemic didn't create WeWork's original problems. It made some of them much harder to solve. Millions of employees began working from home. Companies reconsidered how much office space they needed. Demand across parts of the commercial office market weakened. For a company carrying expensive property commitments, that was a serious problem. Still, WeWork survived. And in October 2021, it finally became a public company. This time it didn't use a traditional IPO. It merged with a SPAC, a special purpose acquisition company, called BOEX Acquisition Corp. The transaction initially valued WeWork at approximately $9 billion. That was a huge decline from $47 billion, but it gave WeWork another chance as a publicly traded business. The problems, however, weren't over. The company continued struggling with losses, debt, and its property portfolio. By 2023, the situation had become critical. In August, WeWork warned that there was substantial doubt about its ability to continue operating. And on November 6, 2023, WeWork and certain subsidiaries filed for Chapter 11 bankruptcy protection. At that point, the company still faced billions of dollars in long-term lease obligations. Bankruptcy gave WeWork something it badly needed: the ability to restructure. It could negotiate with landlords, reject leases, reduce debt, and shrink the portfolio that had become such a burden. And that is exactly what happened. In 2024, a US bankruptcy judge approved WeWork's restructuring plan. The company eliminated approximately $4 billion of debt. It renegotiated more than 190 leases, exited more than 170 unprofitable locations, and reduced future rent costs by more than $12 billion. In June 2024, WeWork emerged from bankruptcy as a private company. And this is perhaps the most important part of the entire story. WeWork did not disappear. As of 2026, the company says it still has more than 600 locations across more than 30 countries and over 100 cities, which tells us something important. The original idea wasn't necessarily the fatal mistake. Flexible workspace had real customers. WeWork built a globally recognized brand. The mistake was what happened around that idea. The company expanded extraordinarily quickly, while losses remained enormous. It made massive long-term property commitments while offering customers much greater flexibility. Its valuation climbed faster and faster, helped by investors willing to provide billions of dollars in capital. And that rising valuation created its own illusion of success. Because valuation and value are not the same thing. A private valuation tells you what investors agreed the company was worth during a particular financing transaction. It does not mean the company has earned $47 billion. It does not mean the company is profitable. And it does not guarantee that the next investor will agree. WeWork discovered that in the most dramatic possible way. For years, private capital allowed it to grow without having to prove itself to the public market. Then the IPO forced investors to examine the entire machine. The growth was real, the revenue was real, the customers were real, but so were the losses. So were the billions in lease commitments. And so were the governance problems. The IPO filing didn't create those problems. It exposed them to a much larger group of investors. If there is one fatal mistake at the center of WeWork's story, it is this. The company treated rapid expansion as evidence that the business model had already been proven. It hadn't. More buildings produced more members and more revenue, but they also created more costs and more long-term obligations. As long as investors were willing to keep financing that growth, WeWork could continue expanding. Once confidence disappeared, the weakness of that dependence became impossible to ignore. And that is why WeWork matters far beyond co-working. Because businesses don't fail simply because they stop growing. Sometimes they fail because they grow before they've proved that the growth itself is sustainable. In January 2019, investors valued WeWork at $47 billion. By October, the rescue valued it at around $8 billion. 4 years later, it entered bankruptcy, and yet the company survived. Smaller, restructured, and very different from the company investors once imagined. WeWork didn't prove that flexible offices were worthless. It proved something far more useful. Growth can make a company look successful, but eventually the economics still have to work.